Hi, I'm Andy, and welcome back to the AI Investing Challenge. After last week's pick, Experian, and this is unlucky number week 13, I half expected the AI to start checking my credit score before choosing this week's stock. Like, Andy, you bought too many coffees. Your financial behavior is concerning. Therefore, I'm picking a safer stock. But no, the AI is still behaving, mostly. If you're new here, this challenge is simple. Every Friday after the market closes, I invest £10 into a UK-listed stock chosen entirely by AI. No overrides, no second-guessing, no hum, but I saw a YouTube video that said, just pure, unfiltered machine judgment. And today, I'll walk you through the stock the AI picked this week, the current value of that investment, the total value of the challenge so far, and the next stock the AI has already chosen for next week. So, what did the AI pick this week, and why? Let's dive in. Please be aware I am not a financial advisor, and nothing in this video should be taken as financial or investment advice. Everyone's situation is different, so please do your own due diligence and consult with a certified professional before making decisions. Investing always carries risk. Your money is never guaranteed, and you could lose some or all of your investment. To keep things fair, and to stop the AI from just picking AstraZeneca every week, the challenge uses the same structured rules. It must choose a UK-listed company with solid financials, medium-term growth potential, no major red flags, and it can't pick the same stock again for at least 6 to 8 weeks. This keeps things realistic and stops the AI from becoming obsessed with one stock like it's binge-watching a Netflix series. This week's pick is Smith & Nephew, ticker SN. They are a global medical technology company specializing in orthopedics, sports medicine, and advanced wound care. In simple terms, they make the stuff that fixes you when you break, tear, twist, sprain, or generally mistreat your body. They are a major player in the medtech world, supplying hospitals and surgeons across the globe. Why does it matter? Because demand for medical devices tends to grow steadily. People don't stop needing knee replacements just because the economy is having a wobble. The AI sees Smith & Nephew as a blend of stability and recovery. The medtech sector has strong long-term demand, and procedure volumes have been rebounding since the pandemic. The company has been improving margins, tightening costs, and rolling out new products, all of which support medium-term growth. It's not a flashy stock, but it's a steady, financially disciplined one with room to climb. Here are the key figures the AI looked at this week. PE ratio of 22.8 times. Forward PE of around 14 times. PEG ratio, roughly between 1.0 and 1.2. Revenue growth at 6.1% year-on-year with an underlying revenue growth of 5.3%. EPS growth at 52.8% year-on-year. Net debt to EBITDA at 1.7 times. Cash conversion improvement of 24.4%. Free cash flow, $840 million, up 52.5% from last year. Those are the raw numbers. Now let's talk about what they actually mean. Let's break these numbers down and translate them into something more human than a spreadsheet. The PE and forward PE are like looking at a house price today and then seeing what the estate agent thinks it'll be worth next year. A higher trailing PE says the market used to think the stock was pricey. But that lower forward PE? Well, that's the market quietly whispering, we think earnings are about to improve. It's like spotting scaffolding on a building. Something's being upgraded. The PEG ratio around 1 is basically the Goldilocks zone of valuation. Not too hot, not too cold, just right. Imagine weighing a cake. The price is the weight, the growth is the flavor. PEG tells you whether the flavor matches the weight. Hey, it does. Revenue growth in the mid-single digits is exactly what you expect from a mature medtech company. Think of it like a hospital heart monitor, not spiking wildly, not flatlining, just a steady, reassuring beep. That's what you want in this sector. EPS growth jumping over 50% is the exciting part. That's like a runner suddenly shaving minutes off their time. It tells you they've improved their technique, tightened their form, and found some extra efficiency. For a company, that usually means margins are improving and operations are running smoother. Net debt to EBITDA at 1.7 is comfortably manageable. Picture someone carrying a backpack. This isn't a giant hiking pack stuffed with camping gear. It's more like a sensible day pack. Noticeable, but not weighing them down. Cash conversion improving by 24% is a sign that the company is turning its profits into actual usable cash. Last year, it was around 60 to 70%, which means the figure now is around 80%. It's the difference between having a fridge full of ingredients and actually cooking dinner. And that free cash flow, $840 million, is the real fuel. It's the money that lets them invest, innovate, pay dividends, and grow. Think of it as the company's oxygen tank. The fuller it is, the further they can go. The metric that really sealed the deal for the AI was EPS growth combined with strong free cash flow. That combo screams. Margins are improving, operations are tightening, and the business is converting growth into actual cash. For a medium-term strategy, that's exactly the kind of momentum the AI wants. Smith & Nephew ticks all the challenge boxes. Financially solid, improving profitability, strong sector tailwinds, manageable debt, consistent demand, risks. Healthcare procedure volumes can fluctuate, competition is fierce, and regulatory hurdles are always lurking. But overall, the medium-term outlook is positive, steady growth, improving margins, and a sector that doesn't go out of fashion. So, how many shares did my £10 buy? At the time of purchase, the share price was £11.54.5. That means I bought just over 0.86 of a share. And right now, at the time of recording, the value of that investment is £9.98. So taking into account the stamp duty and the slightly late purchase as I was away, not a bad slight increase in a few days. Here's the updated AI challenge pie, showing how the fund is split and how the challenge is performing so far. As always, investing carries risk. Prices can go up or down. The total value of the challenge is currently £130.33, which means an overall gain of 33 pence since we started. But remember, this challenge is about the medium term, not quick wins. Each week I am tracking each stock's performance that week. And this week, the stocks had a little less time with a slight delay in last week's video. But there's been some big swings. The best performer was Royce, up 44 pence, or up 5.29% since last week. But there were a number of losses too, the biggest of which was London Stock Exchange with a loss of 60 pence or 6.17%. To keep things diversified, the AI won't pick Smith & Nephew, Experian, AstraZeneca, Halma, CURY's, Sunbelt Rentals, Computacenter, or Royce again for at least 6 to 8 weeks. And now, the moment you've been waiting for. The AI has already chosen the stock for next week. And that stock is Sage Group plc. We'll break that company down in the next video. If you want to follow this challenge week by week, make sure to like this video and subscribe. It really does help with the algorithm. Also, feel free to leave any comments. I'd love to know your thoughts and what you'd like to see in the future. If you want to see any of my other videos, check out the ones to the right of this video now. The bottom one is the one YouTube thinks you may like to watch next. See you next time.